Class is in session. Let's do our Drew Diligence. In today's lesson, we'll be figuring out what the heck Nvidia even does. Then we'll see what kind of numbers they're putting up. First things first, this is not financial advice. I'm not a broker, this is purely my own educational research. I'm new to this. Honestly, I've invested like a genius and like an idiot. I don't have the balls for volatility. I've learned due diligence actually matters, and this channel is just me sharing my notes. For total transparency, I hold NVDA today, but I might sell it tomorrow. It could be perfectly priced already. Rule number 1, do your own research. Don't be an idiot, and remember to do your Drew diligence. Nvidia was founded back on April 5th, 1993, anchoring its global headquarters in Santa Clara, California. To understand how they scale so efficiently, you have to look at their fabless operational model. In the tech industry, being fabless means Nvidia doesn't actually build or maintain the multi-billion-dollar manufacturing foundries required to physically bake silicon. Instead, they focus their core energy on design and intellectual property development right out of Santa Clara, drawing up the blueprints and locking down the IP. From there, those designs move into wafer fabrication and advanced packaging. While TSMC's foundries in Taiwan handle the core advanced manufacturing, a major strategic move is their expansion into the new Phoenix, Arizona fabs, which are coming online specifically to support next-gen Blackwell production stateside. Once the raw silicon is baked, it moves into system assembly, which is diversified across the United States and Latin America, to build out final, large-scale enterprise infrastructure. Running a global machine of this size requires massive footprint scaling. Today, Nvidia's key operational assets span over 42,000 global employees, holding it down across 38 different countries. And what this entire pipeline is actually pumping out has evolved far beyond basic graphics cards. The final product output is a suite of completely integrated hardware and software accelerators. They are delivering full-stack computing power by unifying GPUs, DPUs, and CPUs under their proprietary CUDA platform. Now that we see how the hardware moves from blueprint to final product, let's look at how this operational engine translates into raw revenue. Nvidia's journey is defined by a series of high-conviction, sequential architectural pivots. It all started back in 1993 with their initial founding thesis. During this early PC graphics and multimedia era, the entire focus was strictly on 3D gaming and pushing raw processing speed. That foundational work led to a massive breakthrough in 1999 with the release of the GeForce 256, the world's first true GPU. Then came 2006, a massive turning point marked by the launch of the CUDA platform. This kicked off the parallel processing era, opening up GPUs for general scientific calculations instead of just rendering video games. By 2012, we hit the AlexNet era and a hard pivot into artificial intelligence. This deep learning pivot proved that GPU acceleration was fundamentally required to train and scale modern AI workloads. In 2018, they pushed boundaries again with the RTX launch, bringing hardware-accelerated ray tracing to the mainstream. Which brings us to 2024 and the rollout of the Blackwell platform. This marks the beginning of the AI factory era, where the business is fundamentally shifting away from selling discrete chips, moving instead toward delivering massive, full system racks. Next, let's break down the revenue mechanics and inflow. Nvidia's total net revenue scaled from $130,497 million in fiscal year 2025 to a massive $215,938 million in fiscal year 2026, delivering a strong 65.47% year-over-year growth rate. Looking at our reportable segments, compute and networking is the undisputed driver, surging 66.51% to reach $193,479 million, commanding 89.6% of total revenue. Meanwhile, the graphics segment pulled in $22,459 million, representing a 10.4% share with a 57.01% growth velocity. When we index this by market platform, the data center business completely dominates the grid. It generated a record $193,737 million, capturing 89.72% of our total mix with a 68.2% year-over-year jump. Gaming follows at $16,043 million, or 7.43% of inflow, while professional visualization at $3,191 million, automotive at $2,349 million, and OEM and other round out the bottom of the board at $619 million. Finally, tracing the transaction lifecycle flow anchors how this cash is realized. The pipeline starts with direct and indirect orders from hyperscalers and OEMs, moves through the physical fulfillment and delivery of the hardware architecture, and culminates in revenue recognition. Hardware revenue is recognized cleanly upon shipment, while software configurations are deferred over time. To see how healthy this model actually is, let's look at the core financial trends over the last few years. Starting with total net revenue, Nvidia scaled from $60.9 billion in fiscal 24 up to $130.5 billion in 25, and then jumped over 65% to finish fiscal 26 at $215.9 billion. Now, gross margin did compress slightly, dropping from a 75% peak down to 71.1%. But even with that minor dip from shifting to full system hardware, operating income still surged 60%, climbing to $130.4 billion. Net income followed that exact same momentum, jumping nearly 65% year over year to hit $120 billion. To keep this growth engine running, they poured heavy cash back into the business, ramping up R&D to $18.5 billion and scaling CapEx to $6 billion. But here's the kicker. Operating cash flow grew even faster, bringing in a massive $102.7 billion. That leaves them with over $62.5 billion in raw cash sitting right on the balance sheet. At the same time, they optimized their debt, paying it down by nearly 12% to finish the year at $7.4 billion. When you look at the final ratios, the strength is obvious. Their debt-to-equity ratio is a dirt-safe 0.04, meaning they barely rely on leverage. And their return on equity comes in at a spectacular 61.4%, proving just how efficiently management is turning capital into pure profit. To understand the driving force behind Nvidia, we have to look closely at its core leadership framework. The company has been anchored from day one by CEO Jensen Huang, who officially stepped into the role on April 5, 1993. His technical background sets the tone for the entire organization. He earned his bachelor's in electrical engineering from Oregon State in 1984, and later completed his master's in electrical engineering at Stanford in 1992. Before co-founding Nvidia, Jensen built his industry experience directly in the trenches of Silicon Valley. He started out as a microprocessor designer at Advanced Micro Devices from 1984 to 1985, and then spent the next 8 years rising through the ranks at LSI Logic as a division director and product manager. This engineering-first perspective directly drives the company's central mission statement: to enable a world where everyone can experience the power of AI. Ultimately, that vision funnels down into one massive core objective: transitioning roughly $1 trillion of legacy data center infrastructure over to accelerated compute platforms and GPU-centric real-time AI factories. Let's look at the core risks and headwinds officially disclosed in Nvidia's SEC 10K filing. First up is massive customer concentration. Right now, just 2 direct clients generate 36% of their total revenue, making them incredibly sensitive to the spending choices of a tiny group of buyers. To make things more complicated, those exact same cloud hyperscalers represent a growing custom silicon threat. They are actively building and deploying their own internal AI processors to try and cut down on third-party GPU reliance. Then we have a deep supply chain vulnerability. Nvidia operates on a single-source manufacturing model that is heavily reliant on TSMC, meaning any major global disruption hits their entire pipeline immediately. Geopolitical export licensing is another massive hurdle. Strict U.S. export limits into China recently forced a painful $4.5 billion inventory write-down on their books. Even if they build the chips, the physical deployment is hitting operational gateways. Real-world rollouts are hitting a wall because they are strictly constrained by data center power and regional grid capacity. Finally, there's a hidden startup investment risk. Nvidia currently has $17.5 billion parked in private companies and illiquid infrastructure, which carries a completely different risk profile than their core business. Put some pressure on that like button and subscribe to the channel if you'd like to see more of this type of content. With this being the first video I have ever edited, I'd be happy to read any feedback you might have that could enhance the value of the channel. If so, leave a comment below. If you want to roast me, please at least make me laugh. As a final reminder, this whole breakdown is strictly for educational and informational purposes, not financial advice. Make sure to do your own independent research and due diligence before risking your capital.